If you receive Social Security in 2026, the government just handed you a raise. The official number is 2.8%. For the average retired worker, that is about $56 more per month. It sounds simple? It is not. Here is the part almost no one tells you. That raise is not really a raise for everyone. For some retirees, the entire increase will be quietly eaten before it ever reaches their checking account. For others, that same 2.8% could push them across an invisible line that costs them hundreds, even thousands of dollars in higher Medicare premiums or new taxes on their benefits. I want to be precise about this. The Social Security Administration confirmed a 2.8% cost of living adjustment for 2026. Nearly 71 million Americans are affected. The money is real. The money is yours. But here is the tension I need you to sit with for the next 20 minutes. Being given a raise and actually keeping that raise are two completely different things. Millions of retirees will see the bigger number on paper and never understand why their net deposit barely moved. I do not want that to be you. So stay with me. Let me tell you why nobody explains this clearly. The system is not designed to inform you. It is designed to pay you. The Social Security Administration sends you a one-page notice in December telling you your new benefit amount. That notice does not explain the earnings test. It does not explain how your Medicare Part B premium interacts with your raise. It does not warn you that crossing a certain income line can suddenly tax up to 85% of your benefits. It just shows you a number. So you see 2.8% in a headline, you feel a small flush of relief, and then life moves on. Nobody sits you down and walks you through the machinery underneath. That machinery is exactly where the money is won or lost. By the end of this video, I'm going to give you 3 specific things. First, you will understand exactly how the 2026 COLA is calculated and where it quietly leaks away. Second, you will know the precise income thresholds and dollar amounts that can erase your raise or trigger new costs. Third, you will have a clear, do-it-this-week action plan to protect every dollar you are owed. And stay with me all the way to the end, because the most valuable item, the one that helps the highest number of people keep the most money, comes near the very end. It is the piece that even financially careful retirees miss. I saved it for last on purpose. Now, before you decide whether this applies to you, let me stop 2 assumptions. If you think this is only for low-income retirees scraping by on a small check, you are wrong. Some of the most expensive mistakes I see happen to people with comfortable savings because their other income pushes them into higher Medicare premium brackets and higher taxes on their benefits. The more you have, the more this can quietly cost you. And if you think this is only for the wealthy, you are also wrong. The earnings test, the benefit taxation rules, and the programs that help cover Medicare costs hit modest income retirees hardest. Because for them, every single dollar of that $56 raise matters. I am also talking to the people next to the retiree. I am talking to the spouse who depends on a survivor benefit. I am talking to the adult child acting as caregiver, managing a parent's mail and finances. I am talking to renters on fixed incomes and to widows who have never handled the household money before. This affects you too. So here is my promise for every single item today. I will tell you plainly who this helps the most. No vague answers. You will know whether it is your situation or not. My name is Anna Walter. I am an estate attorney, and I have spent more than 10 years sitting across the table from retirees and their families, walking through exactly these numbers. Let me tell you the most painful pattern I see. It is not the people who made reckless choices. It is the honest, careful, hard-working people, the ones who paid into Social Security for 40 years, the ones who saved a little, kept their paperwork, never asked the government for a thing they did not earn. Those are the people who lose money to mistakes they could not even see. Not because they were careless, but because nobody ever explained the rules in plain English. The money does not disappear in a dramatic way. It leaks. A higher premium here, a taxed benefit there. A few $100s a year, every year, for the rest of their lives. That kind of loss is quiet, it is invisible, and it is completely preventable. I am going to make sure that is not you. So let us start with the foundation. What exactly is the COLA, and why does it behave the way it does? COLA stands for Cost of Living Adjustment. Every year, the Social Security Administration looks at inflation and raises your benefit so it keeps pace with rising prices. The law ties this increase to a specific measure called the Consumer Price Index for urban wage earners and clerical workers. That is a mouthful, so just call it a price tracker. When prices for everyday goods go up, your benefit is supposed to go up by roughly the same amount, so you do not fall behind. For 2026, that adjustment is 2.8%. Here is why that number matters. The average retired worker's benefit goes from about $2,015 a month to roughly $2,071 a month. That is the $56 figure you keep hearing. Now let me give you the analogy that makes this click. Think of your COLA like a small raise at a job, where the raise is calculated before taxes and deductions. Your boss says, you are getting a 2.8% raise. You feel great, but then payroll takes out for health insurance, and the cost of that insurance went up too. So your actual take-home pay barely changes. The COLA is the gross raise. What lands in your bank account is the net. And the net depends on what gets pulled out along the way. Here is why this exists and why it stays hidden from you. The COLA exists because decades ago, retirees were watching inflation destroy fixed benefits that never increased. So Congress built in automatic raises. That part is genuinely good. But the deductions and thresholds that interact with your benefit, things like the Medicare Part B premium and the income taxes on benefits, are governed by entirely separate rules in entirely separate agencies. The Social Security Administration handles your raise. The Centers for Medicare and Medicaid Services handle your premium. The IRS handles the taxation. No single letter ties all three together for you. Let me make that real for a second. In 2026, the standard Medicare Part B premium is rising from $185 a month to $202.90 a month. That is an increase of $17.90 every month. Now, look back at your raise. The average raise was about $56. The premium increase eats roughly a third of it before you ever see a dime. And that is the standard case. For some people, it eats far more. This is real money. It is your money, and the only way to keep it is to understand each piece. So, let us walk through them, one at a time. Number 1, the Medicare Part B premium offset. This is the single most common reason a retiree's raise seems to vanish. Your Part B premium is usually deducted directly from your Social Security check before it is deposited. So when the premium rises, it comes straight out of your benefit. Here's how it actually works. In 2025, the standard premium was $185. In 2026, it is $202.90. That is a jump of $17.90 a month, or about $215 over the year. If your COLA raise was the average $56 a month, you keep roughly 38 of it after the premium increase. The headline said 2.8%. Your wallet felt closer to half that. There is a protection here you should know about, called the hold harmless provision. In simple terms, your Part B premium increase generally cannot be larger than your dollar COLA increase. So your net Social Security check usually cannot go down because of the standard premium rising. But hold harmless does not protect everyone. It does not protect people new to Medicare in 2026, people who pay their premium directly rather than through their check, or higher income retirees paying income-related surcharges. Who this helps the most? Every retiree enrolled in Medicare Part B, but especially those whose entire COLA is roughly the size of the premium increase. What to do about it? When your December COLA notice arrives, do not just read the benefit number. Find the line that shows your Part B deduction and calculate your actual net deposit. Know your real number, not the headline number. Number 2. The income-related Medicare surcharge, known as IRMAA. This is the one that catches the most innocent people. I want you to pay close attention here because this trap closes on people who did nothing wrong. Here is what it is. If your income is above a certain level, you pay more than the standard Part B premium. The surcharge is called the Income-Related Monthly Adjustment Amount, or IRMAA. In 2026, the standard premium is $202.90, but with IRMAA surcharges, the monthly premium climbs through several brackets, reaching as high as $689.90 per month for the highest earners. Now, here's why it catches innocent people. IRMAA looks at your tax return from 2 years earlier. So your 2026 premium is based on your 2024 income. Imagine you sold a house in 2024, or took a large one-time withdrawal from a retirement account, or a spouse passed and you filed differently. That single year of higher income, even if your income has since dropped back to normal, can spike your Medicare premium for the entire year. You feel like you are being punished for something in the past, and many people never realize they can fight it. Who this helps the most? Retirees who had a one-time income event 2 years ago, recent widows and widowers, and anyone who recently retired and now has much lower income than they did while working. What to do about it? If a life-changing event reduced your income, you can request a reconsideration using Social Security Form SSA 44, titled Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. Marriage, divorce, death of a spouse, work stoppage, and loss of income-producing property all qualify. File it. Most people never do. Number 3. The taxation of your Social Security benefits. Here is a fact that shocks people every year. Your Social Security benefits can be taxed by the federal government, and a COLA raise can push more of them into taxable territory. Here is how it works in plain English. The IRS uses a figure called combined income, which is your adjusted gross income plus any non-taxable interest plus 1/2 of your Social Security benefits. If you file as an individual and that combined income is between $25,000 and $34,000, up to 50% of your benefits may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. Now here is what should make you angry and then make you act. Those threshold numbers have not been adjusted for inflation since the 1980s. They are frozen. But your benefit rises every year with the COLA. So each year, the COLA quietly pushes more retirees over lines that never move. You did not get richer. The line just sat still while your benefit grew. Who this helps the most? Middle-income retirees with a mix of Social Security and other income, like a pension or retirement account withdrawals, who sit right around those thresholds. What to do about it? Talk to a tax preparer about the timing of your withdrawals from retirement accounts. Sometimes taking a little less in a given year or doing strategic Roth conversions in lower income years can keep you under a threshold and save real money. This is general education, not personal tax advice, so run your specific numbers with a professional. Number 4, the earnings test, if you are still working. Many retirees do not realize they can collect Social Security and keep working. But if you are below full retirement age, there is a catch. Here is how it works. In 2026, if you are under full retirement age for the whole year, Social Security deducts $1 in benefits for every $2 you earn above $24,480. In the year you reach full retirement age, the limit is far more generous at $65,160, and the deduction is only $1 for every $3 over that amount, counting only the months before your birthday month. Let me make that real. Say you are 64, you claimed early, and you take a part-time job earning $34,480 in 2026. That is $10,000 over the limit. Social Security would withhold $5,000 of your benefits. People are stunned when that happens. Here is the part that matters, and that almost nobody explains. That money is not gone forever. Once you reach full retirement age, Social Security recalculates and gives you credit for the months that were withheld. So it is more of a delay than a permanent loss. But the cash flow shock in the moment is very real. Who this helps the most? People who claimed benefits early and are still working, even part-time. What to do about it? If you are working and under full retirement age, know your earnings limit before you take that extra shift or seasonal job. Plan around $24,480 for 2026 if you want to avoid withholding. Number 5, the programs that pay your Medicare costs for you. This is the highest value item in this section, and it is criminally underused. Here is what it is. There are programs called Medicare Savings Programs, run through your state Medicaid office, that can pay your Medicare Part B premium for you. That is the same premium we discussed, the $202.90 a month. If you qualify, the state pays it, which means that money stays in your pocket. And in many cases, your full COLA actually reaches you instead of being eaten by the premium. Let me give you a real picture. The Qualified Medicare Beneficiary Program, the QMB, can cover your Part B premium, your deductibles, and your coinsurance. That alone can be worth well over $2,400 a year just from the premium. There is also a related federal benefit called Extra Help that lowers prescription drug costs, and it can be worth roughly $5,900 a year. And here is the most important point. The income limits for these programs are higher than most people assume, and several states have loosened or eliminated their asset limits entirely. Millions of eligible people never apply because they assume they earn too much. They are leaving thousands of dollars on the table every single year. Who this helps the most? Lower and modest income retirees, and a surprising number of middle-income retirees in states with generous limits. What to do about it? Contact your state health insurance assistance program, called SHIP. It is free. They will check your eligibility for Medicare savings programs and Extra Help and help you apply. I will give you exactly how to reach them later in this video. Let me tell you about someone. I will call her Doris. Doris is 73 years old. She lives in a small house in a Midwestern town, the kind of place where she has known her neighbors for 30 years. She worked as a school cafeteria manager for most of her life, raised 2 kids, and lost her husband 4 years ago. Her income is her Social Security benefit, a tiny pension, and not much else. Careful with money her whole life. Never asked for help. When the 2026 COLA was announced, Doris was glad. $56 more a month, she thought. But when her net deposit barely moved, she could not figure out why. The premium increase had quietly swallowed most of it. She assumed that was just how it worked, and that there was nothing to be done. Here is the single action she took. Her daughter saw a video much like this one and called the local SHIP office on Doris's behalf. 1 free appointment. The counselor ran her numbers and found that Doris qualified for a Medicare savings program that paid her entire Part B premium and for extra help on her prescriptions. The result? Between the premium she no longer pays and the drug savings, Doris keeps roughly $3,200 more per year. That is not a one-time check. That is every year for the rest of her life. On her budget, it is the difference between worrying about the grocery bill and not worrying. Same person, same life, same income. The only difference was that someone finally looked. Now contrast Doris with a man I will call Robert. Robert is 68, retired comfortably, sold a rental property in 2024 for a healthy gain. In 2026, his Medicare premium jumped because of an IRMAA surcharge tied to that one-time sale. Robert assumed it was permanent and just paid it. It was not permanent. A single SSA 44 form, citing his work stoppage and lower current income, could have reduced it. He never filed. He lost money he did not have to lose. The difference between Doris and Robert was not income. It was information. Now let me give you 3 things almost nobody talks about. These are for edge cases, but if one is yours, it is worth real money. First, for surviving spouses. When one spouse dies, the household keeps only the larger of the 2 Social Security benefits, not both. That can be a sharp drop in income. But here's the piece people miss. The survivor also moves from filing jointly to filing as a single person, which means lower tax thresholds and often a higher Medicare premium bracket on the very same income. Who this helps the most? Recent widows and widowers. What to do about it? Before the end of the year a spouse passes, talk to a tax professional about your filing status and your IRMAA exposure, and file Form SSA 44 if a death has lowered your income. Second, for veterans. If you are a veteran with limited income, there is a benefit called aid and attendance, an addition to the VA pension for those who need help with daily activities or are housebound. It can add a meaningful monthly amount on top of a basic pension, often more than $1,000 a month for a qualifying veteran. Who this helps the most? Wartime veterans and surviving spouses of veterans with care needs. What to do about it? Contact an accredited VA representative or your county Veterans Service office. It is free and they handle the paperwork. Third, for homeowners. If your home has appreciated and your property taxes have climbed, many states and counties offer a property tax exemption, freeze, or deferral for residents over 65. In some places, this freezes your assessed value, so your tax bill stops climbing. The savings can run several hundred to over $1,000 a year. Who this helps the most? Longtime homeowners on fixed incomes in rising markets. What to do about it? Call your county assessor's office and ask specifically about senior exemptions, freezes, and deferrals. Rules vary widely by state and county, so you must ask locally. Here is exactly what to do starting this week. Step 1. Today. When your COLA notice arrives, or right now if it already has, log in or create your free account at ssa.gov/myaccount. View your exact new benefit amount and your exact Part B deduction. Write down your real net number. Step 2. This week. If you had a one-time income event 2 years ago, or a major life change like the death of a spouse, retirement, or loss of income property, download Form SSA 44 from ssa.gov and file it to potentially lower your Medicare premium. Step 3. This week. Contact your free state health insurance assistance program to check your eligibility for Medicare savings programs and extra help. You can find your local SHIP at shiphelp.org or call the National Medicare line at 1-800-MEDICARE. That is 1-800-633-3733. 4227. Step 4. For tax questions on your benefits, get free help. AARP Tax Aid and the IRS Volunteer Income Tax Assistance Program, called VITA, both offer free tax preparation for seniors and modest income filers. You can find VITA sites through irs.gov. Now let me address 2 worries. If you are not good with computers, you do not need them. Every program I mentioned has a phone number and offers in-person help. Call SHIP and a real person will walk you through it. And if you threw away old paperwork, do not panic. Social Security and Medicare have your records. The county assessor has your property records. You can get copies. A serious warning. Scammers target seniors during COLA season. The Social Security Administration will never call you demanding payment, gift cards, or your full Social Security number to release your COLA. Never pay a fee for these benefits. Every legitimate program I named is free to apply for. If a company offers to get your benefits for a fee, walk away. Let me bring you back to Doris. Remember, nothing about her income changed. Her benefit was the same, her life was the same. The only thing that changed was that someone finally looked at the rules on her behalf, and she kept $3,200 more every year because of it. That is the entire lesson of this video. Being entitled to money and actually receiving that money are 2 completely different things. The 2.8% COLA is yours by law. Whether you keep it depends entirely on what you do next. One honest disclaimer. I am an attorney, but I am not your attorney, and this video is general education, not personal legal, tax, or financial advice. The rules I described vary by state, and your situation is unique. Please confirm your specifics with a qualified professional or the agencies directly. If this helped you, do one thing for me. Send this to one person you love who is over 65. The retiree who needs it most is almost never the one who goes looking for it. Be the daughter who made the call. Be the reason someone keeps their money. Subscribe, turn on the bell so the next one finds you, and I will see you in the next video.